It is important to note that only for financial assets there can be reclassifications, not for financial liabilities. And there can only be a reclassification when there is a change in a business model. Now I want to discuss impairment. But before we do this, let's briefly revise our IAS 36 impairment principles. We will only impair assets if there is indicators of impairment. Then we will calculate the recoverable amount, and the difference between our carrying amount and recoverable amount shall be recognized as an impairment in our profit and loss. Now, why do I include definitions and principles of other standards in our lectures? Guys, you should be able to identify the different principles and different rules. Then IFRS 9 indicates to us that when there is impairment of financial assets, we will use our expected credit loss model. Now, important guys, expected credit loss model to calculate any credit losses. Now, impairment of financial assets will only apply to financial assets at amortized cost and at fair value through OCI, which is mandatory. Therefore, guys, which is compulsory. Impairment will not apply to our fair value through profit and loss. Now, we will divide our assets into three categories. Our first category will be our trade receivables, contract assets, and lease receivables, and we will follow our simplified approach. Our second category will be financial assets that are originated or purchased, being credit impaired. Therefore, guys, they know when they purchase these assets that there is a high risk that these assets will be impaired, and we will apply our lifetime expected approach. And our third category will be our other financial assets, and we will apply our general approach. Now, our credit loss is the difference in the present value of our expected cash shortfalls. Now, what does this mean, guys? We need to calculate our expected cash shortfalls over the period and then bring this back to our present value. Now, let's first have a look at our simplified approach. Unfortunately, guys, this is a lot of theory and we do need to work through this. We will look at examples as well. The entity is not required to determine whether the credit risk has increased significantly since initial recognition. Now, when we have trade receivables and contract assets that do not contain a significant financing component, we may recognize a loss allowance and measure this at an amount equal to our lifetime expected credit losses. In the second scenario, when we have trade receivables, contract assets, and lease receivables that do contain a significant financing component, our entity can choose the accounting policy and measure a loss allowance at an amount equal to our lifetime expected credit losses. Okay guys, I know I have said this, but this is unfortunately theory that we need to work through. I am going to look at an example with you guys. Let's just quickly work through this and then we can work through examples. Our lifetime expected approach, remember this is our credit impaired assets. This is where there is a very high risk of impairment, and important, we may recognize this based on our lifetime expected credit loss at each reporting date. And extremely important, you will have to calculate the effective interest rate used. Therefore, you will have to adjust this if there is credit impairment 3, general approach. Now this is the approach that we will use majority of the time normally. Now you will identify that I have divided this into 3 categories, 1, 2, and 3. Our first one is that there will be no significant increase in credit risk. Then we need to recognize 12-month credit risk losses. Second one, there will be a significant increase in our credit risk. Then we need to recognize expected lifetime credit losses. Now, how do we calculate this? You need to calculate the interest using effective interest rate calculated on the gross carrying amount. Remember, this is a financial asset. This will be before adjustments of any loss allowance. Now, guys, I am going to indicate to you what this means in our example. Number 3, credit impaired. Guys, again, recognize our lifetime expected credit losses. Credit impaired. Now, you can read through the calculation on your own. What I want to indicate to you is that you have identified my green everywhere. If you look at my simplified approach, guys, recognize lifetime expected credit losses. If you look at my second one, trade receivables, contract assets do not contain significant financing component, the entity can choose to recognize lifetime expected credit losses. Credit impaired assets, at the bottom, guys, lifetime expected credit losses. Our general approach, we have, again, guys, if there is a significant increase, lifetime expected credit losses, and credit impaired, lifetime expected credit losses. Now, why do I indicate this to you? If you need to study this, you can remember lifetime expected credit losses. And then there's one instance, if there is no significant increase, you need to recognize for 12-month period only. Then day 1 gains and losses. What is this? On initial recognition, when we recognize our transaction, our fair value can differ from our transaction costs. Now, in this scenario, the transaction cost referred to the amount paid, the consideration. Now, this difference we call our day 1 gains and losses. But how do we recognize the difference? This will depend on the valuation technique on calculating our fair value. Then I want you to please open your IFRS 9 B 3.2.1 and we will look at the derecognition of our financial assets. Derecognition of financial assets. Now my recommendation, include a flag on this page. But what can you write on the flag? Now the response I received is that you can write any word that appears on the page that you are flagging. You will identify that I have included DERECOG as my derecognition word is too long. But guys, can you use abbreviations on your flags? You need to be very careful when you use abbreviations. The abbreviations that you use should be in line with our industry. For example, PL, profit and loss, OCI, and so forth. Guys, as soon as the abbreviations appear to be crib notes, yes, it might not be, but if it looks like crib notes, they will take your textbook. Okay. Now, let's just take this one step back. Remember, you may not write in your standard. I want to quickly talk about our definition again. Remember, the financial instrument definition is where we have a contract between two entities that will result in a financial asset in the records of the one and a financial liability or equity in the records of the other. Now, why will an entity purchase a financial asset? What is the purpose? The purpose will be to receive future economic benefits, to receive cash flow. Now guys, you will understand why I've discussed this definition just now. Let's work through the flow chart. We need to determine whether the derecognition principle below are applied to a part or all of an asset or group. Question number 1. Have the rights to the cash flows from the asset expired? Now guys, first, when will these rights expire? This will be at the end of the contract. And then, if this is yes, you need to take out and derecognize that asset. Our next question, if it is no, we need to determine, has the entity transferred its rights to receive the cash flows from the asset? Now, you will identify that I have included paragraph 3.2.4. Now, important guys, this is paragraph 3.2, not B. Remember, the flowchart is included in B 3.2. They are referring to paragraph 3.2.4. 3.2.4 indicates to us that the transfer can be a contractual right, or number 2, retain the contractual right but assumes the contractual obligation to pay cash flow to another entity. Now, if you think about our financial instrument, the purpose of a financial asset is to receive our cash flows. Therefore, if this entity either 1, transfer the right as part of a contract, or 2, has the obligation to pay the cash flow that they receive to another entity or party, then they would have transferred the rights. If they transfer the right and your answer is yes, you need to take out that financial asset. If your answer is no, they can continue to recognize the financial asset. Therefore, when you look at our flow chart, you will identify number 3 is, has the entity assumed an obligation to pay the cash flows from the asset that meets the conditions in paragraph 3.2.5. And they include to us that this relates to 3.2.4. Now guys, conditions will be to pay the cash flow to another entity where they have agreed to transfer the cash flow. If your answer is yes, we need to ask our next question, number 4. Has the entity transferred substantially all risks and rewards? If the answer is yes, derecognize and take out the asset. If the answer is no, has the entity retained, therefore kept, all the risks and rewards? If the answer is yes, continue to recognize the asset. If the answer is no, has the entity retained control? Remember guys, control, who receives the future economic benefits from that asset, our cash flow. If our answer is no, derecognize and take out the asset. If yes, continue with your recognition.